Hello and a very warm welcome to your Global Markets Technical Outlook for July 2016, brought to you by HelixTrader.com. A little bit late with the technical outlook this quarter. I normally try to get it out at the end of June, but really wanted to wait and see how the whole Brexit thing had played out and affected the markets. So we'll see as we go through the charts how that's played out and where we are now in the general scheme of things. Of course, everything that you're about to see and hear is just for your educational use only. Nothing that you're about to see or hear is a recommendation to buy or sell any financial instrument. Trading and investing in the financial markets, as I'm sure you're well aware, is a risky business, and if you have any doubts about your decision-making ability, you should always consult the counsel of a licensed financial advisor. So let's kick off as usual with the US stock market, and on the very long-term basis, this is the chart. This is the Dow going back to 1900. It's always good to use this as our starting point. A lot of people are asking me, when's the next crash coming? One thing that I think is interesting when you look at it on a long-term basis is that as we see the market very much characterized by these long sideways periods of consolidation through the sort of 20s and 30s here, again in the 1960s up to about the 1980s, and then what we've just been through really from the late 1990s up to about 2013, and what you'll and the in between times they're punctuated by these long sweeping up trend maneuvers, and what you'll find is that most of the market crashes come in these consolidation phases. You know, we had the 1929 crash here, the various crashes through the 1974 crash there, and then we had the dot-com crash and the GFC, of course. And then if you look in between times, the actual when you're inside these long sweeping up moves, what you find is that the volatility of the market contracts, and there's very, very little risk of a crash happening while the market is in this trending phase. So the question for us now at the hard right edge of the chart here is, have we truly broken out of this consolidation phase, and are we now in a new trending phase? If we think we are, then the probability of a major crash on the scale of 2000 or 2008 becomes much reduced. So if we could really just be at the very start of something that lasts for many years, or this could be a false breakout. It's probably a little bit too early to tell, but my sense is that given the low volatility that we've seen in the market since 2009, I think it's fairly safe to say that we are in now a low volatility environment, which should mean that the probability of a crash, of a major crash, is much less, at least for the short term. If we drill down into the monthly chart, we can see that that was the large consolidation phase between 1999. We got the breakout there into 2013, and the market has been in this sort of well-behaved uptrend. Continues to work within this channel. There doesn't seem to be any sign that it's ready to pop out. Certainly not to the downside anyway. We've broken into new highs on a monthly basis. So once again, everything looks fairly rosy. You can see Brexit in here. It's this second, the penultimate candle on the chart here, and it's barely recognizable in amongst all the other stuff that's going on there. So in effect, it was a bit of a non-event in terms of its effect on the markets, and it will have long-term political and effects for Britain itself. But in terms of the markets, they seem to have sort of shrugged it off, you might say. Always good to lay the Andrews pitchfork across the monthly and just see how well behaved the trend is. And once again, you can see it. This tool here, I'm using these charts from TradingView.com, which I think is a really good free chart website. But what they do is they split their Andrews pitchfork into these four zones here, with the center line up through the middle of that zone, and you can see the market tends to sort of move within these zones and then move between the zones. Interestingly, the market tending to find support and resistance at that center line as it goes up. There was another point here, broke through here, recovered quite quickly. This was the early sell-off at the start of this year, and as you can see now moving back up, back towards that center line, which is now around about 2200. So I think that's perhaps where we could see the next area of resistance. Of course, 2200 a round number as well. So so we're likely to possibly run into a little bit of supply in that region. Obviously, the market has had a good run, pretty much for the whole year, really. So it wouldn't be unusual to see us, at least coming into some sort of profit taking, or as I say, some supply coming back into the market at that point. On a weekly basis, you can see it's again very much in this well-behaved uptrend channel. Sold off and came right back and touched the line which was previously drawn between the 2011 correction there and the original 2009 lows. So that was a real sort of a good time to get in, if you like. Very hard to catch sometimes, but we can say with hindsight that that was a good point for the market to turn. And as you can see again now into new highs. It's difficult to say what kind of pattern this is. Maybe a little sort of an irregular inverted head and shoulders, perhaps. But it does now look like we're clear of that, and we're back into all-time new highs. So we're back into clear air, if you like, and blue skies ahead. It doesn't mean that there won't be corrections along the way, but certainly we're in this channel now. We've already tagged the bottom of the channel, so you would expect that eventually the market should progress towards the top of the channel, which is off the top of this chart at the moment. On the Ichimoku, now you can see here we had the cloud cross back in early in 2009 actually, when we got the initial cloud cross. And we've basically stayed bullish all the time. We did get a little bit as we sold off in January. There, we did fall through the cloud, and it was bearish for a month or two. But as you can see, the market has quickly recovered, and the lagging line and the price now both well ahead of the cloud. So I think it's fair to say that the market is once again bullish, and you can see the cloud just below the 2000 level there. So around about 1950 is where it would have to get back to before we would be concerned that it was turning bearish again. So looking down to the market internals and seeing what we can find out about the state of the health of the market, if you like. This is the bullish percent index, so we're looking at the percentage of stocks in the S&P 500 that are bullish at any one time. I encourage you to look up the makeup of this because it uses point and figure charting in the background. But it's a measure of market breadth, really, and what we want to see is when the market's bullish, we want to see that led by a large number of stocks, a large percentage of stocks. Late last year, we had some divergence as clearly stocks were being sold down. The market was still rising or going sideways at least. And then we got these two sell-offs, but August last year, January this year. But encouragingly, this measurement's gone straight back into create a new high and then a higher low. So, and we've got the market into all-time new highs again. So we've got confirmation effectively that this move is genuine, and there is underlying buying behind it. Currently, 75% of stocks in the S&P 500 are bullish at the moment, and that's a healthy measurement. That's the sort of number that we would want to see for this market to continue to go on and make new highs. These charts can diverge for long periods, as you've seen here. So even if this starts making slightly lower highs, that wouldn't be a concern immediately. The market could still progress on as long as it stays at reasonably good levels, north of the mid-60s anyway. Another market breadth one to look at is the percentage of stocks above their 200-day moving average, another quite well-known measure of bullishness. Again, this breadth measure was diverging last year, diverging a lot more than the bullish percent, as you can see. But once we got that major correction in January, this thing has rebounded convincingly, I guess you could say, and we are now getting higher highs and higher lows. This thing now calling 75, so around about the same amount of percentage of stocks. This one looks across the whole of the NYSE, though, not just at the S&P 500. So this one now 75% of stocks bullish, according to them being across their 200-day moving average. So once again, that gives us confirmation that these new highs are being well supported by the underlying stocks. A quick look at the yield curve now. If you remember from prior presentations of these, if you're not sure what the yield curve is, please look it up or go back and watch the videos from the past. But in essence, what we're looking for here is during bull markets when risk is low, we want the yield curve to be positively sloped from low to high, with short-term interest rates being lower than longer-term interest rates. When risk gets elevated, this curve will turn more horizontal and possibly even what's called inverted, where it's running from the top left to the bottom to slightly down to the right. So here's the solid red line at the bottom is where we're at the moment, and as you can see, it looks nothing like what we're worried about. So for what this means is that risk remains low in the market. Money is cheap as well. You can borrow in the States for 0.25% at the moment, and a lot of that money is finding its way straight into the stock market, which is why we're seeing new highs going on. So until this line flattens out or turns inverted, there is nothing to see here, as they say. So again, that's a confirmation that the bull market is intact and is healthy. On the sentiment ratios, this is the put-call ratio, so looking at the ratio of puts to calls, and when there are more put buyers in the market, this ratio will rise. When there are more call buyers in the market, this ratio will fall. You'll often see market inflections at extremes on this chart. So these red circles mark the large corrections that we've had. This one from earlier this year, this last one here is Brexit. So you can see not quite even getting up to this bearish extreme, which is the green line here. But at the moment, you can see this is going down. So the buyers of calls are becoming more aggressive. People are more bullish in the market. Nobody wants to buy many puts, so there's not much in the way of protection. People are not worried about downside risk. So this thing is heading in a bullish direction, and it is in this neutral area, which means that the market should go on to make higher highs until this, if and until I should say that this measure or this indicator gets down into what's called this bullish extreme, where the call buyers have overwhelmed the put buyers, and everyone is frantically trying to jump on the very end of the move. We're clearly not there yet, but this is a good one to keep an eye on. Once we do get towards that area, we should have an early warning that we're getting in towards some high. But like I said, at the moment, that doesn't seem to be the case. On the VIX, this is another sentiment measurement. As you know, it seems to fall into these three zones if you study it over a long period of time. Between the sort of low 20s and 10ish is when risk in the market is low. Above 22 and to about 40 is when risk tends to be elevated, and above that level is high risk. That's when we're talking global financial crisis or market crashes of some description or other. As you can see, we're at 12 at the moment, so that's very low. That implies complacency amongst investors. Once again, nobody is concerned about volatility. The VIX indicator itself comes from the forward expectations of option buyers. So it's implied volatility of options. When volatility is low, there is very little interest in owning options as an insurance, and this thing will tend to fall. And so, as you can see, we're right down at those low levels, and this thing is easier to time when it's elevated than when it is low. You can see here that it can just wobble around for months on end, really, at these low levels. So it's very hard to call a top with this indicator, but much easier to call bottoms when you get this sort of behavior here. But the point is that even though it's low, it can still go lower, and it can remain low for long periods of time. So this by no means says that we're nearing the end of this move. There may be still plenty of juice left in it. And a quick look at the cycle. Now, this is the election year cycle. Of course, we're in a presidential election year in the United States, and as you can see, this chart here basically sums up all those years from the past, and then sums them all to averages them, I should say, and you get this sort of average line of what the stock market should do. Interestingly, if we put what the S&P 500's done since the start of this year along the bottom here, you can see that this thing has managed to call the lows pretty nicely. It called the one in sort of February there, the one that we got in May, and then the Brexit low as well was also here. You can see these arrows here are a little bit diagonally bent towards the right as well, as it were. So what that tells us is that the cycle is moving a little bit ahead of what the market is. So this has given us kind of an early warning. Now, the big caveat with all these, with anything to do with cycles, is that they're just a guide. They're by no means a forecast of what's going to happen in the market. So you have to take them with a very big pinch of salt. Having said that, where we are right now, which is right here, recording this at the end of July, you can see we are in a very bullish phase cyclically. And have the capacity to remain so right up until let's call it the end of August. If the cycle is moving a little bit ahead of us, let's call it the end of August, beginning of September. So we could be in for some sort of intermediate high. If the market does scream ahead to that point, it will become very overbought, and that wouldn't be so much as of a surprise. Some correction going into towards the US elections held, of course, in November. So perhaps just a little bit of uncertainty moving into that time frame, and then a bounce as the final candidate or the final outcome is better known. The polls in the States are quite close at the moment, which is a little bit worrying, but the markets at the moment clearly not taking much notice of that and powering ahead. So one to keep an eye on, but like I said, it's one you have to take a little bit of a pinch of salt with. So on the US stock market, of course, it's in a long-term bullish uptrend. There's no question about that. A child could tell you the market is going up. We've seen that very strong recovery from the Brexit low, so that's encouraging. That didn't cause more damage than it might have. So we're seeing, I think the probabilities do favour this market to continue to move into new highs, at least into that September time where we might want to. That might be when it starts running into that 2200 level as well. So that would be a sort of combination of time and that price to watch out for. But of course, the long-term fundamentals remain strong. So I think any pullback is probably an opportunity to get long this market. But that's what a lot of investors will be thinking anyway. That's certainly not a recommendation from me. But overall, I think the outlook for this market is positive. The resistance at 2200 is, and support way down now at about 2000 on the downside. Looking now at the Aussie stock market, and as you can see on the monthly chart, this has we're in an uptrend. There's no question about that. We've seen higher highs and higher lows ever since 2009. A lot of people will say, well, it's just been going sideways and we haven't seen much happen. But you can't question what you see on the chart. That's a higher high and a higher low there. We got that sell-off back into that sort of 5,000 level. It just dipped. There was what you might call a false breakout down to that sort of 4,700 level, but quickly recovered, and as you can see, it's powering ahead with some nice big green candles. For my money, we're in that zone now. We're in between 5,000 and 6,000. Clearly 6,000 has to be the target. Whether we get there on this move or whether we need another rotation before we get up there is open to question, but there's nothing bearish about this market that you could pick out. To me, it looks very bullish, and nothing more to say about that really. It's going up. On the weekly chart, You can see here that there's that sort of false breakout. It did quite come right back to support, which was created back there in April of, well, that's going back to 2013, would you believe? But that was just clearly a head fake, and there's probably a lot of stops sitting under that 5,000 level, so they would have all got wiped out, and then the buyers just reasserting themselves. Again, perhaps a little inverse head and shoulders there for my money. It's it's a bit scrappy, but could be one in there. If you measure the height, I haven't done this yet, but what's that, about 500 points, say, take the breakout somewhere around about there, maybe 5,700, something like that as a target, maybe around about this 5640 area would be one to watch out for. You can see that's just picking up resistance from earlier in 2014 there, perhaps somewhere around about this highs. We might see a bit of a reaction coming in, but if it can clear that, then 6,000 has to be the next major target. On the Ichimoku chart, well, again, this was looking quite weak through 2015. The price and the lagging line had both fallen through the clouds. That told us the market was bearish. It was looking quite bearish for a time, obviously, but you can see that's convincing recovery, I guess you'd call it, the price now through the cloud, just waiting for the lagging line to come up. So technically still bearish, but you can see the price and the lagging line both pointing near vertical. And interestingly, that 5640 level from the weekly chart is exactly where the cloud would be crossed by the lagging line. That would take us into bullish territory. So that will be a price or an index level to watch for sure as we come close to that area. Switching now to the currencies now, and the Aussie dollar. Well, there's no question that this is going down. We're seeing all the stock markets going up, but this is in a severe downtrend, as you can see. No sign of a bottom at this stage. We did just get a nice bounce off that 70-cent level, and perhaps it could make it up to 80, or at least back to the upper trend line there. But it's looking weak. We're seeing a lot of these sort of weak wicks on the tops of the candles. That's generally not a very bullish sign. And if it lost 70 cents, then I think we'd be back to the GFC lows, around about 63 cents. How low could it go? Well, this goes all the way back to the float, and 48 cents, as you can see, was the all-time low there. So, so that's it's possible. It's not it's certainly not out the bounds of possibility. So we'd certainly have to keep our eye on that. But I think if it got to that 63 level, that would certainly be an area where there would be some interest in it, at least I think. And who knows? It could stabilize and at least spend some time consolidating at that area. But right now it's 75, and I think there will be a lot of currency traders who will be becoming aggressive on the short side if this thing comes up anywhere close to 80 cents, and that's sure to send it lower again. On the euro, another currency that's not doing as well as it could have. It broke through that $1.20 level, which has been key for this currency really all the way back to 2003 on this chart. That was a key level of support, and it just sliced straight through it. That was back in 2014. Now just sort of catching its breath a little bit after that major move lower, and we're in between that sort of $1.05, $1.20 area. I think once again, if the euro got back up anywhere near $1.20, I think there would be a lot of people waiting to open fresh shorts, close short-term longs, and that could have the next shoe could certainly drop, and we could be sent lower again. Again, this currency has not been around for a whole lot of years. Back in the late 90s it was created, and as you can see, there's not much support once you get back through that $1.05 level. All-time low in this market is about 83 cents. If you measure the height of this pattern and project it lower from the breakout point, it actually gets you 80 way down there. So that's a long way down. I actually heard some commentary this week. Somebody had a target in the 70s for the euro. So that all sounds very bearish. Clearly, even if any of them were to eventuate, that's going to take a long time to get there. This is a monthly chart. These are monthly bars in here. So, that could be years away. But for now, I think it's just stabilized in here, and if anything, I think we could see a retest of the breakout point at some point in the near future. Well, let's call it the next 6 months or a year. So I think that's where this market's headed then. On the British pound, the poor old British pound, it got whacked, with the Brexit. But, having said that, it's actually been in quite a stiff downtrend ever since 2014, really. So this sell-off through Brexit wasn't really anything that, was unusual. I mean, it wasn't in an uptrend to begin with, so maybe it got whacked a little bit more than it would have done otherwise. But now, not quite all-time lows. You'll see I've got one more chart on this to show the long-term picture, but certainly broke its GFC lows, which were around about that $1.35. As you can see, it's about $1.31 at the moment, and there's just nothing on this chart to write home about. It's just very, very bearish indeed. We can zoom out into the very long term. Here's a very long term chart going all the way back to 1953, and the website I got this off was saying that what this chart shows is the decline of Britain as a power, as a world power, and maybe there's something to that here. The pound is in this very, very long term downtrend, as you can see, got almost down to parity in 1985, and this was more about dollar strength than pound weakness at the time. And then they had the Plaza Accord round about here, which started to devalue the dollar. I'm sorry, which sort of helped the pound recover a little bit. But as you can see, it's in a long-term downtrend, and it's got further to go. Look at the size of this channel here, and this could go down through parity, which would be big news for the pound. But either way, it's not looking good for the pound, and who knows if the Brexiters will be ruining the decision once the economic effects of this start to play out. On the yen, the yen's actually had a little bit of a good move up. If you look back to the previous video, you'll see I had this one. Now this is the futures, so it doesn't quite. The numbers don't match the yen dollar chart. They are the numbers match, I should say, but they're out by a couple of decimal points. But if you trade the futures, this sort of area of 1.00, as you can see, that was marked on the chart previously. It was previous support here, a little bit of resistance here, and as you can see, it's bounced straight up and hit that level. So, it had gone down a long way. It was definitely oversold. It was overdue for a bounce, and it's certainly come in and just come up and tagged that level. So, being a currency, of course, it loves its round numbers. But it'll be interesting to see what happens next. I think, if you look back what happened here after the sort of major sell-off in the early 2000s, this thing just consolidated for years, almost to 8 or 9 years before it got its mojo back. So I think we're probably in for something similar here, where we're just going to get a long sideways drift of consolidation before the yen gets any legs again. And of course, all those currencies are suffering because of the effect of one currency itself, which is the US dollar, of course. And here we can see that this one has had a good run. It's been consolidating for quite a number of months now. And I'm seeing some commentary, people saying that the run in gold is done because the dollar is going back up again. I don't see that really. It's in an uptrend. There's no question about it. But it's kind of stalled in this sort of upper 90s area. area. I think the next level here that I had marked for resistance was 103. It's kind of got stopped at that 100 level, as you can see. Once again, the round number resistance coming in there and just halting its progress. So once again, I think it's, this is bullish long term, obviously, which is why it's hurting so many other currencies. But it might take another few months before it gets the next leg up. I don't know if this is the start of it. It might be, or it might just run into this consolidation area again and just have another few months of going sideways. But definitely bullish. We've had the breakout, the triangle pattern. We've breached that 92 level, and I think the only way is up for this currency. On the commodities now, and you'll see that the Goldman Sachs Commodities Index is really just telling us the story of all the commodities, really, that they're all on the nose at the moment, and nobody wants to go near them with a bid. So we've had that breakdown through the 575 level. We hit the GFC lows at 300. Got a little bit of a sort of bounce off there, but as you can see, a nice big red candle there towards the end. So this thing doesn't look like it's got any strength on the upside at the moment, and who knows whether it's going to consolidate at these levels. If it breaks 300, that would probably be the next leg lower, I think. But there's really no pattern on this chart yet to go on, really. On the crude oil, it's looking very similar, mostly because the Goldman Sachs index is quite heavily weighted towards energies, but nevertheless, this really shows. Everybody's been talking about oil having a good run. Yeah, I suppose it did. It doubled, I suppose, from 25 to 50. But in the big scheme of things, it's still in a terrible state. Lower highs, lower lows. There's no question about that. And just at the end here, it's just not looking like it's setting up for anything, really. If it puts in a higher low here and then a higher high, then maybe we can start to say that it's starting to look interesting again. But for now, just stuck down in this, 50 seems to be its cap at the moment. So it would need to breach that level before it became bullish again. On the soybeans, just to show you, this malaise in commodities is right across the board. This thing, again, looked like it was having a bit of a recovery, but bang, it's also been hammered again. So it's in a downtrend. There's nothing more to say about that. We'll see what happens if and when it gets back to that 850 level. If it can find some support, but it really needs to break this downtrend line. As you can see, it came up, but just didn't have enough power to get through it this time. So we'll wait and see and keep an eye on this chart as we go. And on the gold, well, everybody's been, the gold stocks are clearly enjoying the run that gold's had, and it has had a good spurt. Interestingly, just came up and tagged that trend line that I've had drawn on the chart for a number of months now, just off these two highs here. And now you can see we've tagged it once again. It just breached it momentarily, but it's now just ducked back below. I'm going to stick my neck out and say that I think gold has bottomed. I'll show you the evidence for that on the next chart. But really, it wouldn't become of interest on the long side until it's got through this downtrend line and above that sort of 1360 area. I think it's going to take another rotation down before it does that, but it's certainly starting to look like it's done on the downside for now anyway. And the reason why I say that is because of this chart here. It's always worthwhile keeping your eye on the silver-gold ratio, which will show you which element is leading. And in this case, what tends to happen is when silver is leading to the upside, precious metals in general will be bullish. When silver is leading to the downside, precious metals will tend to be bearish. We've obviously been in that bearish scenario since about 2011. But I'm wondering now if we're starting to see some green shoots here. We've broken through that downtrend line and it's starting to look a little bit bullish for, in other words, silver is going up faster, or at least is going down slower now than gold is, and so what that means is that the precious metals as a group should become more attractive on the long side. So I think perhaps we've seen the bottom in gold and silver for that matter, but we'll wait and see. It's still a little bit early to call it, but if this can get going, then that should be bullish overall. So just our summary then, the US stock market obviously remaining in that long-term uptrend. The Aussie market also quite strongly trending upwards. Cyclically, we are definitely in a bullish phase, but look towards that sort of end of August, start of September for perhaps some sort of intermediate high in stocks. And as we've seen on the currencies, most of them are weak. The US dollar is the one that's bullish. The Japanese yen's looking not too bad, but perhaps it's done its thing by now. And the commodities have still are weak across the board, which is also tied into that dollar story. And just before we go, just have a quick look at the models that I run on the website. This is the diamond rotational model. It rotates through ASX All Ordinary stock. As you can see, it's having a good run. It's up 14% for the year so far, and this is a very nice system to trade. It's something that I trade myself. I do make the signals available on the website if you're interested. Just use that URL down the bottom there, helixtrader.com/models. This doesn't appear on the public area of the website, so if you just type that into your browser, that will get you, and you can read the background of the system, how it's all put together, and have a look at some example trades and so on as well. The other one I publish is Jupiter. This is a longer term model. This is based on rotates through a small basket of US ETFs, anti-correlated ETFs that cover different markets. As you can see, it didn't do so well last year. Overall, it's been fairly solid, and this year it's having quite a good run, up 13.5% as well. So if you're interested in that, jump on there and have a look. And if you have any questions, of course, feel free to contact me, but that's my email address there. And if you do know anybody else who would be interested in receiving this particular quarterly update, then please pass on the web address for them and ask them to join the mailing list. And with that, I will wish you good luck, good trading, goodbye, and see you next quarter.